Hello, everybody. This is Coach D with TackleTrading.com. I've got a really interesting trade I wanted to talk about. That was a stock position that was purchased on a breakout. So you want to check this out. This is one of those situations where I literally came in within just a few pennies of catching the high. Now, this is one of the concerns when you look to buy a breakout. So I looked to buy the breakout here, kind of on this cup and handle, and got filled again at 127.48. And literally, like, I mean, the high is 127.64. I mean, how close to the top do you get? So pretty impressive, right? And the stock price came down, and what I did was sold a covered call on it to offset some of the risk. And the earnings started, I was looking for it to break out, and the stock just hasn't moved, kind of been, frustrating. So we kept the covered call on it. And I knew earnings was coming and that it was consolidating. So my anticipation for the earnings was, hey, this is about to report earnings. And so just kind of let me point out some of the, here's that earnings date was coming out. And at the time, it was forming kind of a symmetrical type triangle. And so bought a put before earnings while the implied volatility was still relatively low, and had sold a call. So we wound up in a caller. And so post earnings, the stock price didn't move much. I mean, you kind of look at that in there, and let's zoom in on that. Kind of clean that up. You got a little bit of a gap down. Boom, immediately filled its gap, and it's continuing to just consolidate. Now, I think it's got a good chance of breaking out, especially if the market does break out. And although I don't necessarily expect it to break and run hard at this point in time, kind of, as we're getting towards the end of May, I still think it's got that upside potential. Now, let me show you the position on the risk graph. So there's the stock position. That break even point's out there, and it's down a little bit. You can actually see that the stock price would be down. Let me go add in a regular price slice at the current price. So you can see it's down about 300 bucks. And the call we sold is up a little bit. We sold a 124 call for 270, and we made a little bit of money on it. It's hedged us a little bit, so it had a little covered call, not quite enough to cover the drawdown. But the goal was to move the break-even point down, so collected some money on that. And then I purchased the put to create the collar. So now that makes this little risk graph look like a spread trade now. So just to kind of see where you can see all that. And what's really, really cool about this, I think the coolest thing about this is if you look at the numbers down here, the put, the call was sold for 270 and the put was bought for 270. So they're just $1 apart. And so selling the $124 call gave the money to buy the 123 put. And so the insurance essentially is paid for. Now that comes at the expense of the cap. It caps your gain, so you really can't make more, but it battens down the hatches when it cuts down your risk. So basically, we had a $300, a little bit of drawdown heading into earnings, and we just set it up so it would cap it no more than 450, and then, we gave up the upside, which is okay because we were already in that little bit of a drawdown anyway. Just wanted to make sure we prevented the downside. And let me show you kind of how this little hedge works. Let me move this out of the way so you can see that a little bit better. Okay, I'll hide that out of the way real quick. And you can see where if I take the stock out of the equation, the options, the short call and the long put, end up looking kind of like a short stock position. And if you look at the deltas down here, you've got this negative 36 and negative 55, and you add those together and you get negative 92-ish. So you're really close to the plus 100 that you have on the stock. So you're really kind of neutralizing that. So then if the stock loses, say the stock dropped down to 120, if you owned it at 127.48, you'd be down 748 bucks. But with the hedge, you've managed to cover most of that, a good portion of that drawdown. You've reduced your loss on that. So that's where it puts the floor in on the position. It locks down the gains because it gets to the point where for every dollar you lose on the stock, you'll make it back on the options. And again, same thing with the call. For every dollar you make on the stock, you'll get called out if it goes up above 124. So it caps that gain. Now, the earnings is over. And the reason I'm making this video is because we need to unwrap that collar and get back to the original position on that. So the original position was bullish, and I think I still want to have a covered call on it. So my solution is going to be to roll the covered call, leave the put intact because it's already paid for. And if this ends up breaking down, you've got coverage. And then we can start rolling the calls down and make a little bit more money. But we can still hold the asset. And this is a fundamentally strong stock that I'm going to hold on for covered calls and cash flow. It's a good covered call candidate. If it breaks, support here, it's got support zones down below. It's got lots of support zones down below. So it's a fundamentally strong stock that I think is defendable. And so again, if the price of the asset goes down, that's not the point. The point is we can sit and write covered calls and cash flow. And I believe that this has got potential to go up. And the whole sector's got the chart kind of set up to go up. So I think we got some good potential there. So I'm not going to completely unwrap it, but I'm going to roll it so that if it runs up, we can take advantage of some of that. And we got that 127 high, and we can take advantage of some of the stock price rising and still generate some cash flow and income. So here's the solution I came up with. And this is kind of a simple trade adjustment. It's relatively simple. What I did was just create a rolling order on the call that we sold. So we sold the 124 call. So the way I created that is I just right-clicked, create rolling order, and it opens up the ticket. And I went and decided to roll the ticket out. So we buy back the 124, and then decided to roll it out to June. I went out, get a little bit more time, went out to June 23s, and then the 23rd of June, and then rolled it up to let's see, I've got the ticket over here is what I decided to do. I already kind of did that. 128 is what I decided to roll it out to. So just change that out to 128 out above resistance, but still bring in some premium for out there. And I wind up with a little credit still. So you get a little credit. Now it's not, this is going to generate some cash flow. It's going to offset, we're going to lock in the gain on the covered call, which is a profit right now. And essentially watch what this does to the graph when we put that into the equation here. Is it's going to keep the bottom risk intact, and it's going to become a bit of a calendar type caller where selling that longer term June brings in some premium. It'll shift the delta a little bit, and it'll give us the chance to, as it runs up, to profit and benefit from that. So the stock can rise, and promising to sell it out at 128 will actually end up out where we'd actually wind up back in profit if we did get called out. But we can continue to roll calls up and allow us to raise the ceiling on that. And this is, again, just how to unwrap the collar while still generating some cash flow and income, and just compare and contrast the two graphs. You look at the maximum risk 450, but if I left the collar in place, it's kind of pointless. It's keeping me that $300 some odd loss, $348 max loss. So earnings is over. We had battened down the hatches, rightfully so, and now it's just a question of trying to unwrap the collar. And I watched it and waited for the dust to settle before I made these decisions, and decided to go with that adjustment. Now, look, to the downside, it doesn't really change the risk profile much. Still actually reduces the risk to another $5, but it creates us a more positive delta and gives us some bullish activity. And as prices move up, we'll get back into cash flowing properly on that. So right now we've got the put that's still losing a little bit of theta. So that's okay. The insurance is in place, and I actually want to keep the put at this point in time because, again, it was paid for by selling the other covered call, and it is still in this consolidation pattern, stock in a box. And this could go either way, whichever way the market goes, and whichever way the healthcare sector goes. And so if it breaks, and I am expecting it to break the upside, but of course that sell in May concept, it may end up breaking down. You notice the volume's getting real quiet right now. Everybody's kind of playing wait and see. So I think that it's going to drift to the upside and retest resistance at a minimum. And I'd like to have that rolled out so that we can, benefit and get back to break even. And that's just how to unwrap a collar, with creating a rolling order. You could, of course, completely uncover it and just let it go. And that, that's always a wise choice. But I thought, hey, might as well bring in some extra premium at it. And if you go look at what we really did, we went out to, those June options that expire 23rd of June. And went and sold the 128 calls and brought in, if you look at the bid-ask spread on that, we end up bringing in around $220. And so that's going to actually help us put money back in our pockets and to control, again, the downside risk. So this is Coach D, tackletrading.com. Hope you guys enjoyed this little video here.